We have fundamentals and dynamics that are far more beneficial for gold and disastrous for other assets that could drive gold a lot further. But I'm not going to project where it could be. When I mentioned $8,000 gold in multiple interviews over the last year, it's not like I'm predicting that. I'm just simply saying if it merely did what it did before, it'd be $8,000 gold, and that wouldn't be off the page. It's hard to come up with a number. I do think, though, should be speedy. In other words, I think a lot of it could occur if the stock market starts to break in the first quarter coming up and you start to get that money flow. A lot of this could occur during the next year.
2024 has been an excellent year for the broader market, with all the major indexes hovering around all-time highs. After increasing by just 9% between 2021 and the end of 2023, gold has had a breakout year in 2024. With a 28.7% year-to-date return, gold is slightly outperforming the S&P 500's 26.6% gain. In his latest interview, MichaelOliver, a seasoned financial expert, shared his insights on the current state of the stock market and the potential for a major shift in precious metal prices. MichaelOliver states the favorable conditions for gold and anticipates a rapid price surge, potentially reaching $8,000 if historical trends repeat. Oliver warns of an imminent U.S. stock market decline, predicting capital will shift to gold, silver, and occasionally Treasury bonds, as historically observed during significant market downturns. Few investments did better in 2024 than gold, wrapping up its best year since 2010 and one of its largest annual gains on record. Wall Street's gold bugs think prices will climb even higher in 2025. Based on current trends, Oliver identifies the U.S. stock market as a historic bubble, comparable only to India's Sensex and Japan's Nikkei. He predicts a collapse once key support levels break, triggering capital shifts into gold and silver. Regarding Treasury bonds, Oliver suggests that while they might experience a short-term counter-trend rally as funds flow from stocks, their long-term outlook remains bearish due to the prevailing government debt crisis. With U.S. inflation already looking stickier, market players are staying out of longer-dated treasuries, preferring to hold notes on the front end to the middle of the curve anywhere from 2-year to 5-year notes. In a letter sent to congressional leaders on Friday, Yellen explained that the Treasury expects to reach the statutory debt ceiling between January 14th and January 23rd, 2025. Once this limit is reached, the department will deploy special accounting measures to avoid breaching it. Now, we present the clips of MichaelOliver's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
That massive asset class of the U.S. stock market. And by the way, there's a couple that are in sync with us, Nikkei and Sensex in India. Nikkei and Japan, since they equally look like big bubbles. And they're very close to technical levels that we define via our methods for breakage. We argue that once the U.S. stock market breaks, the money will flow like blood, okay? It will go somewhere else. It always does. You go back and look at history for the last 100 years of major stock market declines, you could find something, and that's monetary metals, gold. Sometimes, in fact, many times, T-bonds have also been a good place to be. You go back and look at the dot-com top through 2002 low, bonds did well. Gold did well. Gold did well for 11 years then, from 2000 to 2011. 2007 top to the 2009 bear market low. Gold did well, with the exception of 1 month in there, and T-bonds did well. This time around, it's going to be different. This time around, a lot of people know we have a government debt crisis, and it can't just be wished away. New president can't wave a wand and it goes away. It will cause hemorrhaging. However, we see technically the potential that once the stock market starts to crack in a way that upsets major asset managers, the money will begin to flow and it'll go to the two traditional safe places, gold and related, and T-bonds. However, any T-bond rally you see, while it could be enjoyable for, let's say, a quarter of a year, maybe several months, as money flows out of stocks into T-bonds, it's not going to last. In other words, the guys who analyze T-bonds as a major bear trend, higher rates, are correct. The problem is we see the potential for a counter-trend rally in T-bonds that could upset those people's notions. Not that their notions are wrong, just that there's going to be a counter-trend rally. I think there's a good potential for that. However, don't confuse that with gold as being a viable alternative. So we think that the key now for gold and the key now for the T-bond market is the breakage in the stock market. So if you're in gold, look at the stock market. Okay? Because when it cracks, the blood's going to flow and it'll flow quickly. We have a massive historic bubble in the stock market in the US by all metrics, duration of time, percentage gains, uh, et cetera, et cetera. There's only two other markets in the world that compare, and that's the Sensex in India and the Nikkei in Japan. Barely, not even twice, I don't think, what the price low was in 2009. When they made a low coincident with us, they're only double. We're like 8 to 9 fold in the S&P and 18-fold in the NASDAQ. So, but when it breaks, the money will flow, and it will flow into those categories. And if your objective measure just of simple price, you can see, hey, it's been flowing this year. Why? Because gold and silver are up as much as the stock market. Nobody's touting that, but because we get pullbacks constantly in gold and silver. And yet, year to date, and possibly in 3 more trading days, they'll be up more than gold, than the S&P and the NASDAQ year to date. So money is already beginning to flow, but it'll begin to flow more noticeably and in great volume, literally a couple percent below where you're trading right now. Once you get into next quarter, our numbers shift, meaning the metrics by which we measure momentum of, let's say, the S&P or the NASDAQ or stocks or sectors shifts. Because why? When you have a moving average against which you're oscillating a market, that moving average changes. So it changes over time.
MichaelOliver discusses how gold and commodities have historically risen together during economic shifts, citing the 1970s stagflation as an example. He predicts that capital moving from overvalued assets like stocks into gold and commodities will rise in tandem. As economic pressures grow, Oliver anticipates gold's trajectory will become more parabolic, with silver exhibiting even more exaggerated movements. Despite a lack of mainstream excitement, he notes that significant buyers, including large American investors, are positioning themselves in the sector, signaling smart money's confidence in gold and silver's potential. For an investor with a moderate risk appetite, an ideal portfolio for 2025 would mean investing 50% of his corpus in large caps, followed by 35% investment in gold and 15% in fixed income assets. Safe haven bets like gold and silver outperformed riskier investment bets, surging 25.25% and 23.11%, respectively, thus far in the calendar year 2024. By comparison, equity benchmarks BSE Sensex and NSE Nifty 50 have risen around 9% each during this period. Let's get back to the interview.
And ultimately, the government doesn't control things. I mean, it likes to nudge things, poke things. Hopefully, the Fed likes to think they can take this price, hold this price level steady in this category and let that one go down. They don't like commodities going up. That kind of inflation is bad. But they don't mind when inflation drives stock prices up because they don't call that inflation. And yet it's nothing but a river flow of money they created. It went somewhere else other than the commodities. Right. Well, that flips. You go back to the late 70s, we were in a recession. Stagflation. Fed raising rates dramatically in the late 70s. Commodity prices were exploding. Well, the stock market was a total wasteland. No, they didn't explode as much as gold, but they went up strongly with gold. And I think this time around, they're set to go with the next power leg in gold. I think commodities are set to participate. And they've not always been in sync with gold at all. Sometimes they're quite opposite. In fact, over the last couple of years, gold doubled from 2015 bear market low to 2020, doubled in price. During the same years, Bloomberg went down. When did Bloomberg explode? After gold had peaked and went sideways, about a 50% correction back to its bear lows and then gone sideways. Gold's gone up. So, but I think they're now set technically to hold hands and go together. Why? Primarily because the money will flow out of the massive asset category into that which is perceived to be low risk, higher reward, period. The gold is not some headline chasing market. In fact, if you sell gold or buy gold based on some kind of war news or the election outcome news, that kind of thing, you're stepping into it, okay? It's likely to blow up in your face. So if you shorted after Trump got elected, you're losing in gold, as much as $100 right now. So you don't do that. Gold moves on broader glacial reasons. And again, look at an M2 chart, go back 50 years and take a look. The gold will oscillate that money growth, but it'll stay in tune with it. They degrade the money, gold's going up. And if they have more excuse to degrade the money because they need to hopefully stop price collapse in this sector or that sector, banks, financials, commercial real estate, they'll do so when the chief beneficiary is the monetary metal because it is money. And it's been that way for 3,000 years. We may have forgotten about it, but a lot of the world hasn't. And I think suddenly when the American public, which is not at all bullish on gold, despite its strength year to date, they're not pounding the table. There's no fever in the gold market. That's when you'll see gold start to go more parabolic. Instead of like 3 steps up, 1 step back, it's going to be more like 6, 8 steps up, 2 steps back. And silver will be even more exaggerated. It goes up 4 and drops back 2. It's a bloody market. Yet year to date, silver's up, about as much, if not a little more than the S&P. In fact, in 3 days, maybe it'll be up more than the S&P. So it's not a loser from an investor's perspective if you get in at the right spot. So that's what I'd be looking for. And I think it is smart money. Obviously, somebody's buying it, and it's not just the Chinese. There are large American investors who've been buying into that sector.
According to recent reports, both gold and silver have demonstrated resilience, with market trends suggesting further growth in the coming years. Do you believe gold and silver will continue to outperform in 2025, or do you see other assets offering better opportunities in the face of rising economic uncertainties? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos.